Your hard-earned cash. Everyone wants a piece of it. With Old Mutual Invest's tax-free plan, you can invest up to 33,000 Rand a year and you won't be taxed on any growth your investment makes. What's more, you can earn 8.6% interest tax-free in our Maximized Interest Fund up until 31 March 2018. For more info or to open an account online in minutes, visit taxfreeplan.co.za. Today's the day. Get great financial advice. Do great things. Old Mutual is a licensed financial services provider. Visit taxfreeplan.co.za for terms and conditions.
Warren Ingram, who's a personal financial advisor, he's an executive director at Galileo Capital. We need to start moving on from the subject all about Jacob Zuma, but it's quite nice to sort of position ourselves after Jacob Zuma. Just listening to Ian Kirk a moment ago, Warren Ingram saying, lots of big work ahead, lots of really tough work ahead. We're not sitting in any kind of global sweet spot right now or South Africa. We mustn't lie to ourselves about that. But at least now that we are in the post-Zuma era, we can start thinking about our money differently.
It was so interesting listening to him because, I mean, as you know far better than me, a lot of the time, the execs of these really big companies are quite guarded on air and quite, controlled by their PR engines. And if you listen to him right through to the very end, I felt he was, speaking from the heart, and it was amazing and absolutely right. It is there is this moment of optimism to kind of look forward for a change instead of just defending and batting and hoping and praying that we just get through tomorrow and the next day. I think, as investors now, we can look ahead again and start to look at real time horizons for investors, which is, 5, 10, 15 years instead of next week and next month.
Okay. So how then do we start thinking about retirement and behaving perhaps differently to what we might have in the past?
So I think if we think about, right up until let's say October last year, the JSE really didn't give us much growth for about 3.5 years. It barely tracked inflation. And, that was lousy for savers and investors. But for retirees, a totally different story, because especially, a lot of retirees nowadays would own things called living annuities, So you build up your provident fund. When it retires, you put it into a living annuity and you start to draw an income stream from that. And that income stream is related to the value of your living annuity, which one way or another is related to the value of the local and international stock markets.
So you start out on your 65th birthday, you retire, and you've got R1 million, and then you figure out that if you live for 20 years, you can afford to draw down X%. If you're going to live for 30 years, Y%. If you're going to live for 40 years, Z%. And there's not very much on R1 million there, but that's the principle you're talking about, right?
Exactly right. And so, let's just say that you start out drawing 5%, which is really responsible, and you'd make your financial advisor really happy that you're doing that. And it's 5% of R1 million. Then, that's three, let's just say 4 years ago. And then the JSE does almost nothing. And so, 1 year later, you would expect your 5% to now be 5% of 1.1 million Rand, but unfortunately it's not. It's 1,050,000. And suddenly you're starting to look at this and say, well, hang on, inflation hasn't gone away. Inflation hasn't stagnated. The cost of food is going up. And this trend continued for that time, for 3 or 4 years. So what happened to retirees was, their incomes basically stagnated. And when you take inflation into account, they were actually going backwards. So their whole standard of living was declining. And now we're in a position where there is some hope around the economy. There's some hope around investment markets. And so now it's a time to those people that are invested in retirement funds to say, well, you need to just be very careful now about a false sense of optimism. The market might well go on a nice recovery, which is great. And then, for someone in that position, they might be saying, hang on, it's time for me now to kind of recoup, those unspent years. I need to kind of make up for those expenses and spend some extra money on a new car or a new paint job for the house or whatever it is. And my suggestion is actually to do possibly the opposite. In other words, if the market does go up and your one 1.1 million rand suddenly shoots up to 1.3 or 1.4, you need to use that as an opportunity to actually reduce what you draw. So if you were drawing 5%, consider drawing, for example, 4.5%.
So this is such an important point, because you've fallen behind in terms of the capital growth of this original million. Suddenly, that in real terms, that million's worth a lot less. You get some growth in that million, and suddenly you start, your 5% of the 1.1, 1.2, 1.3 grows every year, and you start feeling like, a very, very distant Rockefeller cousin, and you start living better, and finally you're getting what you deserve, because you saved all your life to get that million together. So actually, you deserve this, and you're counseling us on the hard part of this, to say, rather than letting your drawings go from 20,000, rather keep them at 20,000 and let the capital amount of that money grow so that it lasts you longer.
Exactly right. I think this is the time where if the market goes on a bit of a tear, and I'm not in any way predicting it. I don't have a cooking clue what it's going to do in the next 2 or 3 years, but if it does go on a bit of a tear now, you want as much capital now to grow as much as it possibly can, so that you have capital that's going to last, the next 30 or 40 years, and so that you can then at least get the maximum benefit from your capital for as long as possible. And if the markets really do carry on, then by all means, then you can review. It's a bit like, a business that goes through a tough time. As things get a bit better, that business needs to build up a bit of a buffer again. And I would view a living annuity in exactly the same way. Now is the time to build up that buffer again, and get yourself a little bit ahead of the game, and hopefully the good times last for quite some time. But if they don't, at least when the next sort of storm comes, that you're well insulated from that.
Yeah, it's such an important observation there, and you've already you've seen your lifestyle deteriorate for the last couple of years anyway. You've got a new kind of normal. Don't go and ruin it for yourself now, because if you chow away at the capital as it's growing, you will find yourself on the back foot once again. If not this year, then next year or the year after. Markets do go up, and they do unfortunately come down eventually.
Exactly, and I think why I feel a little bit more comfortable in a year like this to say this is because we also likely to see some interest rate cuts this year, and we've had some help from the very strong rand, where we see things like the fuel price coming down. So for the average consumer out there, yes, VAT has gone up, but at the same time, if the cost of petrol is coming down and potentially interest rates are coming down, then for most people the cost of living is going to ease somewhat, and that's probably the time to say, okay, let's get a little bit of that economic benefit that and use that opportunity then to tighten the belt on the other side in terms of what we draw. So I think it's that environment that I think makes it conducive to doing that now, whereas a year ago it just wouldn't have been possible. Everything was going backwards.
I don't want to cause panic and confusion, but a really important question is, at a time when the rand strengthens, very few people take money out of the country. People tend to want to take money out as the rand is falling, and falling hard and fast, and it almost creates a virtuous circle of uncertainty. The rand is relatively strong compared to its most recent history. There might be some people to say, you know what, I want to buy 100% offshore living annuity, because over time the rand is going to depreciate again, and I will then get the benefit of foreign income. And that's a very attractive possibility.
It is, and I think intuitively, it's something that a lot of people think about, and so to illustrate the danger of a point like that, if we just think about the strength of the rand post Nenegate, it's strengthened by more than 20%. So if you were invested 100% overseas in your living annuity, which you can do by just in terms of the law, suddenly you're in a position where your capital has gone backwards by 20%, and that means that the income that you're drawing has gone backwards by 20%. And so that one-way bet, which a lot of people have taken, has to a large extent backfired. And the thing about the rand is, when it goes on a long cycle, that either weakening or strengthening, it can last much longer than you think. And so if we're in a position in another 18 months or so from here, where the rand is sitting at 12 or 12.20 to the dollar, that means you're still below where you were at the whole Nenegate issue. So I think it's not smart to just to send all of your money in a living annuity offshore, and rather take a proper approach of good diversification. Have local assets in there as well as international assets, and by all means have international assets. We're not saying don't. I think it's a time to be to be diversified. And the nice thing now with that change in the budget to the way that unit trusts and especially I think balanced funds have been changed. Balanced funds will be able to increase their offshore allocation to 30% of their fund value. So that you're going to find that just the funds that you invested in, if you're in a living annuity, typically would be increasing their offshore allocation when they see the opportunity, and when they're concerned, they'll be reducing their offshore allocation. So I think a lot of that freedom comes in at that fund level already.
Warren Ingram, thank you, from Galileo Capital. He's a personal financial advisor and an executive director at Galileo Capital.